Brought to you by Prescient Investment Management. Informed by science. Guided by insight. Prescient Investment Management is an authorized FSP.
Welcome to one of the very first episodes of Honest Money for 2023. I'm taking a big, deep breath before I start because I think we've come through such a dramatic 2022 and actually a dramatic few years that, talking about the year ahead, which is what I want to do now, is always going to be tricky. We've had such a kind of volatile environment, both on stock markets, global politics, South African politics, lots of speculation from economists and politicians about, countries around the world, including South Africa, going into recession, partly around the world because of interest rates, and then in South Africa because of interest rates and our beloved Eskom causing stage 6 load shedding and, breaking all sorts of unwanted records about, a number of days per year of breakdowns and load shedding, which I think is just a nice way of saying blackouts, which is really what we're in. So I think it's important when we're in such a volatile time just to kind of give ourselves a context. What can we control? What can we think about? What can we do? And then how do we plan our finances to deal with all of these things that are changing all the time? And I think for me, the one really big key point is don't get fixated on big, scary or big, exciting projections or predictions from anybody, whether it's me or some famous talking head, whether it's about technology or anything. I think understand that when economists do predictions, for example, about what the stock market's going to do in the year ahead or what interest rates are going to do for the year ahead, even inflation predictions, they are not as accurate as if you had to flip a coin and say, I'm going to call heads or tails. And it's important there to understand economists, that doesn't mean economists are lousy at their job. It's just that we ask them to make predictions, which is not their job. Economists are there to understand long-term, very big trends and how those impact both economies and then investment environments. So asking an economist what the rand's going to do in the year ahead, it's an entertaining thing to do. And the economists, if they're polite, they usually give you an answer. But what they really should say is, I don't have a clue. I don't know. I can give you a scenario where I think the rand will get better, and I can give you a scenario where I think the rand will get worse. And if you ask me to tell you which one will be more likely or less likely, I can do that. But actually, I don't know. And the honest answer is nobody knows. So when you're sitting there and you read a big scary prediction, online from some big investment house that says the global economy is going to go into recession and all stock markets are going to go down, just understand that prediction is almost certain not to be right. And now you're going to base your long-term investment strategy on something that you are fairly sure is going to be wrong. And it doesn't matter how intelligent the person is that's making that prediction. It doesn't matter how eloquent they are and how many graphs they throw at you. It's still going to be wrong. So let's stop focusing on those predictions. Predictions for me are exciting when you're talking about your favorite sports team and what they're going to do in the weekend ahead and what the weather's going to do. But look at your weather app. The weather app is using masses of data and really complicated, algorithms that are trying to forecast what's going to happen. And truthfully, the weather app can't tell us whether it's going to rain in any city, in any country with certainty in the next 2 hours. Forget about any other time. So if a weather app can't do it, and that's a much less kind of volatile and many, many smaller variables involved than investing in stock markets, why are we worrying about predicting markets? So let's focus on the things we can control. And that's going to be my key point for you today is understand that you can control a few things in your life and around your money. And those are important. You can pull big levers around the way you spend, the way you invest, the way you allocate your money. And those are really critical to the way you're going to build your financial future. You have no control over what the world's going to do around you. So don't worry about it and build your financial position so that you can cater for those big moves that are guaranteed to happen. Whether the big move is going to be up, down, left, or right, I have no idea. All I can tell you is we will always have big moves. That's what happens when the world is driven by human beings. We are volatile and we do move markets and we are unpredictable. That's a reality. That's the one prediction we can make. It's going to be unpredictable. So if I look at what's going on in our environment now and how that applies to you, we are in an environment where interest rates are relatively high in South Africa. We're sitting with prime interest rates of more than 10%. Globally, interest rates are much higher than they have been for over a decade. And it's likely in both South Africa and in the developed world that interest rates will stay high for a little while, and possibly the interest rates might even go up a bit. All of that depends on what inflation is doing around the world. So we are seeing more and more numbers from the US where inflation is starting to get less bad. It's not good, and it's going to take quite some time for inflation to go down to the range where everybody's comfortable. The US Reserve Bank, the Federal Reserve, wants inflation to be right down, kind of around that 2.5%. So when interest rates when inflation has gone from 9% down to 6.5%, it feels like things are going well, but actually 6.5% is still far too high when they want the inflation rate to be 2.5%. So that means interest rates are going to be high because that's the big tool that reserve banks use to control inflation. So for as long as inflation is high, interest rates are going to be high and they're not going to go down. What do you do about your investments? Well, first thing is when you're looking at your money, if you've got debt, and especially credit cards, personal loans, overdrafts, and they're costing you 10 to 25% in interest a year, if something's costing you 25% a year, it's doubling probably every 2 to 3 years. That's really frightening. So if you owe the bank 10,000 Rand and you don't pay it off and you're paying 25% interest, you're going to owe them, 20,000 Rand in a very short space of time. There is no investment in the world that's guaranteed to grow that fast. So it's really important where you can to find a gap in your budget to make sure that you pay down that debt, especially the very expensive debt. What is expensive debt? It's the debt that costs you the most in interest. So it's not the one that costs you the most cash every month. It's the one that charges you 25%. Whereas if you've got a home loan and it's costing you 10.5%, compared to your credit card debt, your home loan is relatively cheap, even though you might be putting a lot more money into your home loan every month. So pay down your short-term debt, your credit cards, personal loans, overdrafts, then focus on things like your car debt, because car debt is also relatively expensive. So if you've got debt and we're in a high interest rate environment, pay down your debt. I know I say it regularly, but right now, high interest rates, this is the time to make sure you're not making the shareholders of the banks rich. You're trying to protect yourself financially. So pay down that debt. On the other side of the equation, because we've now can earn interest on cash, especially overseas in dollars and pounds and euros, which hasn't really been the case since 2009, it means now that having a balanced portfolio where you've got cash, bonds, property, shares overseas becomes much more viable than it has been for the last decade. It's been very scary for people to buy government bonds in dollars or pounds or euros because the interest rates were zero, which meant we knew for a certainty that at some point when interest rates start to rise, the price of those bonds would fall and it would cause investors to lose a lot of money. That's certainly what happened in 2022. And so now when you can earn interest, it means that having a balanced portfolio, 65% in shares with the balance in property, bonds and cash, actually not a bad thing overseas anymore. So if you didn't have a very balanced portfolio with your global investments, make sure that you get that balance right. There was a long period of time where global bonds offered you return-free risk. Just explain that. You're going to get no growth because interest rates are at zero. The risk is there because if interest rates start to rise, the price of the bond goes down. Therefore, you've got lots of risk. The situation has reversed. So now you are in a position where you will get some return on your money. You will get some interest on your bonds, and possibly that the prices will start to normalize again and maybe even get a bit of a rise in prices when investors become a bit more optimistic that inflation has peaked and started to turn. So I think global investments, you can shy away from 100% in shares. You can start to earn a bit more in interest, and especially via the bond market. In South Africa, interest rates are still going to be high for a little while, which means that investors with cash are enjoying good interest rates for a change. If you look at the RSA retail bonds, for example, they're probably paying investors somewhere around 10.5% on a 5-year fixed deposit. That's a very nice rate of interest if you're not paying a lot of tax on the interest. So I think that it's understanding now that government bonds in South Africa are also relatively attractive to keep a balance in your balanced portfolio. And for me, that's probably the big key point around investments for the year ahead. I think equally, we've come through 2022 where our state president has reestablished control over the ANC again. So he's been re-elected. It looks like his top 6 and his top, the top 88 or whatever it is in the NEC are largely on the reform agenda. That means that we should see reform continuing. I don't think anybody's happy with how slowly that reform has been taking place, but if it continues, that's positive news. The big thing that's facing all of us while I'm recording right now, we're facing stage 5 load shedding will be Eskom. And it's really critical that government finds space for Eskom to be able to afford more diesel to kind of get the stages of load shedding down. They do need to kind of reform the whole energy sector very dramatically. At the time of recording, we're hearing rumors, the ANC saying that they want the energy department to take control of Eskom. If that means that the cabinet minister in charge is Gwede Mantashe, I'm really worried about that. So that is something on my agenda. To compensate for that, we will see in the national budget in February the rebalancing of Eskom's debt problem. Hopefully that government takes on a portion of that debt and gives Eskom a bit more ability to invest in the grid, to maintain power plants, and to buy diesel. But surely South Africa has a major energy problem. I think for the whole of 2023, that energy problem is with us, and probably for at least half of 2024. So if you can afford it and you haven't done something yet, make sure that you are insulating yourself from load shedding. If you can, get solar, get batteries, get UPSs, hoping that this problem goes away, because a politician says so. Unfortunately, that's not going to be the case. Looking ahead slightly further, I think that we are looking at how our cabinet will be reshuffled. That certainly hasn't happened yet. And if it's a very business friendly cabinet, I think that's only good news. But beyond that, I'm not too worried about the world going into recession and how that affects investment markets. Understand that markets are always looking ahead somewhat. So the global markets and the South African market has priced in a global recession already. So we need new bad news to drive markets down further. That means that after a year like 2022, where global markets had a really bad time, it's possible that they'll bounce. In most instances, when the US market has a very negative year like it had in 2022, it does often have a very good year to recover. Not a prediction. That's just what happened in the past. If that happens for you as an investor, you want to be exposed to those markets. And equally, the JSE, although it had a slightly positive year, wasn't a great year last year. And so even if the economy goes into recession here, our investment markets are quite cheap. And our stock, our shares, especially the big shares on the JSE, are in no way expensive. So buying shares and holding shares for the next few years, I still think is a very good strategy. No need to be too concerned about bad news in the short term if it's repeating the bad news we already know, because all of that stuff is in the price of markets. So unless we get new bad news, I'm not too worried about the performance of the JSE or the world markets. We still have the Ukraine on the world agenda. As you'll see, just watching and listening to the news, it's become less and less of a topic. Just like COVID was a huge topic, and it's become less and less of a topic. So I think that investors and people in general become more balanced and more understanding of what's going on. They get used to bad news, and then they start to say, well, what else are we looking at? What else is there that we need to focus on for the future? And I think that that's the space that we're in now. So we are positioned for positive surprises. If we get any kind of new good news arriving overseas or arriving in SA, it's very likely to spur our markets to go stronger. I think the rand, for me, I always get asked this question, what's a good level to convert rands to dollars? And for me, I haven't changed my tune for the last few years. I think that the rand at 16.50 to the dollar or 20.50 to the pound is a very good level. That doesn't mean you need to be exact where you wait until it gets to exactly 16.50 before you convert your rands to dollars. It just means that's a nice benchmark. If the rand is somewhere around that level, not a bad time to send your money overseas. Equally, if you've got enough money overseas, don't try and trade the rand, because the rand could go from 16.50 to 15, could go from 16.50 to 19, and no one will be able to predict that until it's already happened. And then they'll give you great reasons why it was so unpredictable. So don't worry about trying to forecast those things. Build your plan, build your asset allocation and your global allocation around your financial position. And then don't worry about the big scary predictions, even if it's me saying it every now and then when I forget myself and make a prediction which I really shouldn't be doing. I think just generally the South African economy is going to have a very tough time. Small businesses are really going to struggle with sustained load shedding. We will see unemployment taking a knock. And so the sentiment, the way people feel, the way we think, and our sense of positivity is going to be very negative. And lots of people will be kind of forecasting the end of the world again. And it's important for you as an investor not to get sucked into that. It's okay to kind of get really angry and frustrated and, shout and scream and, and go and kick a tree if you need to, but don't sell your investments because you're angry or because you're frustrated or because your friends are all worrying about their jobs. You need to make long-term investment decisions. And right now, the stock market is priced in an enormous amount of bad news. So actually worrying about, selling or buying at a different time is really, I think, a waste of time. Stay invested, keep accumulating investments if you can, keep investing monthly amounts if you can, or big lump sums if you're one of the very fortunate few who get bonuses. And then as a reminder, if you've got credit cards, personal loans, overdrafts, pay those down now. Get that stuff off your life and off your balance sheet, because the only people that are really profiting from the high interest rates right now are the people that are earning interest, or the people that are charging you interest, and those are the shareholders of the banks. So I guess that for me, that will probably be my wrap for 2023. Don't be too pessimistic. When the news is really bad and markets are kind of pricing in so much bad news, a lot of people tend to panic and stay out of markets or sell down their investments. That's the time that the savvy investor really buys great investments at a very low price. And I think we're there. We are in the definition of a lot of bad news right now. This is the time not to be fearful. This is the time to kind of load up investments where you can, but just do it sensibly. Don't make big bets on something that's fallen a lot, whether it's a tech sector or cryptocurrencies, anything that's fallen dramatically. It's fine to have some exposure there, but don't go and direct all of your investments there. Proper diversification, proper mix of assets is really important as well. And then stay the course with your investments over this year, no matter how bad the news is. And the news is likely to get bad at some point. You'll get some positive news again. And for you, it's entertainment value. I think it shouldn't be something that you use to inform your investment decisions. Stay tuned. Don't forget to subscribe if you haven't subscribed to the Honest Money podcast. We'll be broadcasting more videos on our YouTube channel as well. So you're welcome to subscribe there as well. And I look forward to chatting to you many times over the year ahead.
Brought to you by Prescient Investment Management. Informed by science. Guided by insight. Prescient Investment Management is an authorized FSP